Hello everyone, my name is Annisa Nurul Fitri with NPM 244120007 from Accounting Class 24A. In this video, I will explain about Value Added Tax System, or in Indonesian, Pajak Pertambahan Nilai, also known as PPN. Specifically, we will focus on two key concepts: input VAT or PPN masukan, and output VAT or PPN keluaran. So, what is PPN? Before we discuss input and output VAT, let's recall what PPN actually is. Value added tax is a tax imposed on the value added at every stage of production and distribution, from procedure to wholesalers to retailers and finally to consumer. In Indonesia, the standard VAT rate is 11%, applied to most goods and service. Business to collect and rebate VAT, as known as pengusaha kena pajak or taxable entrepreneurs. PPN keluaran or output VAT. Now, let's talk about output VAT or PPN keluaran. Output VAT in the tax collection by a business when it sells taxable good or service. In other words, when a company sells something to end customer, it adds 11% VAT to the selling price. This tax doesn't belong to the company, it belongs to the government. The company responsibility is to collect the tax from customer and later deposit into the state treasury. For example, if a company sells clothing worth 10 million rupiah, it must add 11 VAT or 1,100,000 rupiah, and the total invoice become 11,100,000 rupiah. That 1,100,000 is called output VAT, which must be reported and paid to the next authority. PPN keluaran on input VAT. On the other hand, input VAT or PPN masukan is the VAT paid by a business when it purchases goods or service from another taxable entrepreneur. So, whenever a company buys raw material, equipment, or other taxable goods, the supplier will charge 11 VAT. That VAT becomes input VAT, which can be credited or deducted from the company output VAT. For example, if the same clothing company buys fabric from a supplier for 5 million rupiah plus 11 VAT, that's 5,000 rupiah. Input is VAT. How input VAT and output VAT work together? Here, how both are connected. At the end of tax period, usually every month, the business must calculate the difference between output VAT and input VAT. If output VAT greater than input VAT, it means the company collect more VAT than it paid, and the difference must be paid to government. If input VAT greater than output VAT, it means the company paid more VAT than it collect. In this case, the company can carry forward the credit to next period or request a refund or restitution from the tax authority. The system ensures that VAT is only paid on the value added at each stage, not the entry selling price repeatedly. So let's look at simple example. A furniture manufacturer buys wood worth 10 million rupiah with 11% VAT. That's 1,100,000 rupiah as input VAT. Then the manufacturers sell the finished furniture to a retail for 20 million rupiah plus 11 VAT. That's 2,200,000 rupiah as output VAT. Now to calculate the VAT payable, output VAT 2,100,000 minus input VAT 1,100,000 equals 1,100,000 rupiah. That's amount to the manufacturer must deposit to the government, so the tax is only applied on the add value of the 10 million rupiah, the difference between purchase and selling price. Tax credit mechanism. The mechanism is called the tax credit method. and is the foundation of the VAT system used in Indonesia and many other countries. It helps avoid double taxation and ensure that the final consumer is the one who actually bears the tax burden, not the business in between. Each business acts as both as tax collection and taxpayer, passing the tax along the supply chain until reach the end customer. Reporting and documentation. Business must report input and output VAT through amount VAT returns, SPT, masa, PPN. They must also keep supporting documents such as tax invoice, like faktur pajak, which serve official proof of VAT collection and payment. Without proper invoices, the input VAT cannot be credited. Therefore, accurate record keeping is essential for compliance. To conclude, output VAT represents the tax a business collect from customer when selling goods or service, while input VAT is the tax paid on purchase from other taxable business. At the end of each tax period, the company offset the input VAT against the output VAT to determine how much the tax be paid or refunded. The system promotes fairness and prevent double taxation, making VAT a transparent and efficient way to collection revenue. Thank you guys for listening.